Hello and welcome to Thank God It's Friday. This week we are in conversation with Ajit Dayal. He is the founder of Quantum Advisors. Ajit, thanks for joining us. I'm going to get straight to the topic of demonetization, considering it's been 1 year since the government carried out that exercise. Now, in a recently written article which was headlined "Demonetization was a dumb idea" by you, you have mentioned and suggested that the government has wasted a windfall. Can you tell us a little more about what you mean by that?
Sure. I'd like to first preface everything I say by saying that the BJP lovers should not take my statement as a pro-Congress statement. I think the Congress, UPA 1, UPA 2, were pretty much the worst governments India ever had. So when I say something, it's not because I'm a lover of the UPA, UPA 2. I want to put that up front, right up there. I'm looking at data points. So when you look at the reasons or the rationale presented to us as a nation for demonetization, initially there were a few. The main one was get rid of black money and get rid of the sort of counterfeit notes. Everything else, digital India, cashless society, all that came much, much, much later. I think when the government saw that it was failing in its primary reason, supposed reasons to have demonetization on the economic side, it created a whole bunch of other reasons to do it. So I think should be the first thing to recognize is whether we should ask ourselves the question, was demonetization a political move to try to win elections and ensure that the money power of opposition parties was wiped out within UP+4 that was supposed to happen in a few months? Or was it a rational economic move to weed out black money? If it's the first reason, it was a great success because the BJP did win UP. It did not win every other state, but it did win UP. And if it was economic reasons, I think it's a huge question mark, and as I indicate, was a bad idea. So if you look at where India was as an economy, we were just about picking up on a cyclical, natural recovery. You talk to anyone selling any product for that October till November 7th period, from October 1 to November 7, they were seeing phenomenal growth in volumes. We'd had a decent monsoon, we'd had Diwali, optimism was coming through. The capex cycle, of course, of India was not even anywhere on the horizon because capacity utilizations were low and everything was picking up. What happened with demonetization was that the one thing that you can guarantee in India to a large extent, the domestic consumption story, that was completely sucked out and everything fell and everything crumbled. So we had this 3-4 month delay as people had to start getting cash to begin the consumption pattern. And before they could recover from that, you had the GST, which is another angle. But I think demonetization, if the objective was to get black money out, if the objective was to root out the sort of funding going to terrorists, I don't think it succeeded, at least the data points that we've seen so far. Now, of course, we've seen a government going in overdrive the last few days to announce, and I'm sure there are, 10,000, 20,000, 30,000 fake companies that were created to launder money. Fair enough. I'm sure all that is good. But whether demonetization was the way to catch the black money or whether there would have been a better, less harmful way to the rest of the economy, that really should be the discussion.
Ajit, I just wanted to understand, are you saying that you believe that people today are not thinking twice before dealing in cash? And I'm talking with respect to corruption and tax evasion, of course. Or, is there any alternative method, by which the government could have probably tackled these issues?
Sure. I think there are many. One is, I'm sure you have a list in your head of people in this country who have black money. I'm sure we all have lists in our head. I'm sure the government has lists in their head. Maybe they should have gone to raid those 10, 20, 30 people who are huge people and set an example from them. And maybe that would have been a less expensive way of trying to ensure that more people pay taxes. What has the Saudi prince done recently in Saudi Arabia? It's absolutely fascinating. He's gone after his own brethren. He's gone after examples of showing that, hey, these people may have looted the country. I'm putting them in jail, or putting them under house arrest in a fancy hotel, and including Prince Al-Walid, who's meant to know as the Warren Buffett of the Middle East or whatever. So they put big people who were very powerful people, they put them effectively under questioning. They've announced it, And then the next thing that they're probably going to do is announce VAT and taxes for the rest of the Saudi people, so that the common man does not feel that I'm the only one paying taxes. There's someone else there who was not paying taxes, who had black money. They've been caught, and I'm going to do the same thing, and I'm going to make sure that I start paying taxes. Maybe that was a less expensive way of getting black money out. Again, please don't get me wrong. I think getting black money out is very important, and getting a higher tax base is very important. We're discussing whether demonetization, where the whole country was effectively shut down for a period of time, whether that was the correct way of doing it. That's a discussion.
Ajit, then would you say that the impact of demonetization now has been completely absorbed, or probably not yet? And why do you say so?
So I think that from many, when we go out and talk to suppliers, talk to manufacturers, I mean, they kind of say that cash is back in the system. You know, the Indian mind is kind of sadly creative and does all these things in a negative way. So I don't think you should assume for a moment that corruption has stopped. I think that corruption still exists. From what we understand, I gave talks in Pune, in Bombay, in Bangalore, in New Delhi a few weeks ago to a bunch of our quantum investors. And I asked people in the audience, at an average of 80 to 100 people in the audience, I asked people, do you believe corruption has stopped? Are you paying less bribes? And in general, the answer was no. We're actually paying a higher rate of bribe because the risk of getting caught for taking a bribe has increased. Now, this is sort of the common man, if you will, sharing his examples by saying that, yes, they are still giving bribes. And you don't give bribes in check, you give bribes in cash. So we should not fool ourselves to imagine that corruption is eradicated. It is not. People may be more fearful of taking money, and therefore in a risk-return reward situation, as we all know in the field of finance, there's now a higher risk of taking a bribe, so therefore I want a higher price for the bribe. And that's what sort of came out in this little roadshow that I did a few weeks ago.
I love the way he put it, but I can't.
Absolutely. So I'm going to shift the focus to the stock markets to a certain extent. So in that case, is there a growing disconnect between the economy and the Indian stock markets then?
So I think there was a disconnect. If you look at the quarterly numbers that came out from December right through nowish, kind of September-ish numbers are not all out, but there was certainly a dip in quarterly profits. Now, if I step back a bit in time, for the last 3 years since Prime Minister Modi came to power in 2014, the sell-side analysts have begun every financial year with a very high estimate. By the end of the year, it's a very low reality. So what we've been buying in stock market terms, on average in the index, there are of course companies that are doing very well, companies that are doing horribly, but on average you've bought an index where there's no growth in earnings and there's an increase in price. So therefore the PE ratio of the market has increased. Now, to justify this high PE ratio for the next few quarters, for the next year or so, you need to see a 30 to 40% increase in earnings per share. And while we're seeing some recovery now, post-demonetization, post-GST, I don't know whether it justifies or whether it's likely to see a 30 to 40% increase in earnings. And therefore, as a value investor, we're wrong because we've said prices should not be so high, but they are. As a value investor, we're getting nervous to buy in this market because of the valuations. And I'll tell you a few other things. I'm moving back to the macroeconomy a bit, so which also affects stock markets. Where India was in November 2016, a year ago, we had interest rates around the world definitely still low. Now they're creeping upwards, but very gently, they're creeping upwards. We've had a situation where oil prices have gone up about 40–50% from their low of a year ago. And India, as you know, imports about $100 billion worth of oil, and now about 70 billion. So we got a huge benefit from the low oil. So all of these factors make us more vulnerable to external factors compared to where we were pre-demonetization. So I think what demonetization and GST have done in succession is make the economy more vulnerable to external factors after having built up a nice little moat, as Warren Buffett would call it, a moat around the economy, because we'd built up domestic consumption, we'd built our FX reserves, and we were moving downward on an inflationary curve and moving downward on interest rates. Now we could be destabilized because of a self-inflicted wound of demonetization. And that's, to me, something which the market is not yet talking about. You've seen some reaction of it yesterday and today because of oil prices going up and interest rates going up. But there have been comments from international investors that India is the best place on planet Earth to get into bonds. And that's a very powerful statement. But if inflation picks up because of high oil, because of a whole bunch of other reasons domestically, if inflation picks up, interest rates pick up, the foreign bond investor will run for the exit door. And that's not good for your currency, and that's not good for your stock market. So the two successive acts, very good long-term desire to get black money out, very good long-term desire to have a unified tax structure, but the way they were implemented and the timing has opened up the economy to potential repercussions from external shocks that we may not be able to withstand given where we are today.
Sure. True. In fact, there's been increasing talk, about if the bond bull market in India is actually over now. But Ajit, how long can domestic liquidity continue to support the current market valuations then? Because that's a factor that we need to take into account.
For a long time. I mean, people can keep on putting money. Absolutely. So if you think about something, if you were Mr. India and you went to a financial planner and you said, look, I'm 27 years old, 28 years old, Mr. India's median age, what should my allocation be of my savings pool? And every financial planner will tell you, rightfully so, that you should have 40, 50, 60% in equity. And Mr. India has less than 5% in equity. So there is that massive allocation from household savings that over the decades, deservedly, will come into stock markets. Because I strongly believe that in the long run, stocks are the phenomenal way to make great returns to outpace inflation. So there is that driving force. Having said that, we've seen this 5,000–6,000 crores, about $1 billion of flows coming into stock markets from SIPs and domestic investors. But if you go back and look at the data of March 2016, there was a massive withdrawal because in Feb 2016, a year and a half ago, the stock markets in India fell because of China. And I guess retail investors saw the massive decline. And come March, they pulled money out of the stock market. So while there is a wonderful positive trend, please recognize that retail investors will respond to market price action if that's on the extreme. And so far, SIPs have worked beautifully, but you give the market a couple of negative weeks and you bring market prices down, you could have a reaction as you did in March 2016 from the retail investor. So the foreigner has been cautious on India and the retail has been optimistic on the domestic market. If the retail stops to put money in and starts taking it out, I mean, how much can LIC keep on buying? They've been buying everything from the government. Every Coal India offering, everything there is dumped on LIC. How much more can they keep on buying? So I think you have to be careful about this assumption. Again, long-term, domestic money will support markets, rightfully so, but near-term, you could see a mismatch in flows and the reason and the amount of money required to keep markets up. The other thing that, since I spoke about the domestic money, is there is this myth that demonetization has spurred money into domestic retail mutual funds. I think it may not be a primary impact, could be a secondary, tertiary impact. Every other asset class is dead, whether it's real estate or whether it's the FD. So if you're a local investor, you have four choices. You go to the SBI or whatever for your fixed deposit, you buy property, you buy gold, or you buy stocks. Of those four asset classes, two have given you useless returns. FDs are bad and real estate is negative. Gold has given you no return as such, it's been kind of flat. And the only thing moving has been equity markets. So automatically your money will move there, your allocation will move there. And so I don't think it was the demonetization effect as some people are claiming in the press. It's just to the fact that the other asset classes have not done as well. You put fixed deposit rates back at 8% and you see how the money floods back into FDs.
Right. Ajit, how does the government play its cards as we move towards 2019 election then?
So I think the government should recognize, well, there's two things. One is they know and all of us know that they got only 31% of the votes. And that 31% was lower than the amount of votes that Vajpayee got during his tenure when he won the elections for the BJP 99. Vajpayee got 34%. So although Prime Minister Modi got 282 seats, he got fewer percentage votes than Vajpayee. Because of fragmented opposition got a lot of votes, and because they're fragmented, the BJP got more seats. So the Prime Minister knows this, the BJP knows this, hence they've been on election mode, trying to get to a 35 to a 40% vote share so they can win the election, which is fine, and that's what they should focus on, or that's what they should also be doing. The other part is the fact that they won on development, that they want to get India out of the junk rule of UPA 2. And I say that again, UPA 2 was one of India's worst governments. Please don't have them back in power again if you can avoid it. But having said that, the BJP has not fulfilled expectations, however high they may have been, or how high they may have believed it to be over the last 3 years. So I think a combination of, yes, I need to win an election, but focusing on development, focusing on infrastructure spending, which is what they've been doing recently, those are very good things to go on. And if they continue focusing on that, I think development will again take the forefront. But it should not be, things like a bullet train. I mean, I don't know, bullet trains help, and people have done enough calculations that a bullet train between Gujarat and Bombay is not going to benefit the whole, the whole nation too much. But if money was judiciously spent on infrastructure, on other projects that have bigger impacts, I think you could see a win for everyone, for the people of India and for the government.
Ajit, we know at least one member of the Monetary Policy Committee who was turned hawkish. That said, how much more leeway does the RBI have to ease rates further?
So I think given where India is in terms of inflation, reported numbers are low, but one doesn't really know what the agricultural output is. So again, we've opened ourselves up to the fact whether the rainfall will be good or not, whether food production will be good or not, and then therefore whether food prices will be moving up or not. So we've got that risk coming in. We know that on the international side, we've already seen this swing in oil prices, a substantial swing, and we've had the benefit of low oil all these years and now the high oil. So I think the RBI's ability to cut rates is very limited. In fact, I think people should start fearing or factoring in, can RBI raise rates? And under what conditions will they likely raise rates? And if they did that, that would be a shock. I don't think anyone really expected at the start of the year the RBI to raise rates. And maybe now there's one or two, for the last 1 or 2 days, there are people worrying about it. But the general consensus is still very clear that RBI is going to, while they may speak hawkish, they're not likely to raise rates. They may keep them where they are, and they may reduce them over time. So India has to be careful on the inflation front. India has to be careful on fiscal deficits, which includes, so the stress that was caused by demonetization into rural India shows up in 2 numbers. One is Narega, and the other is on the bailouts or the loan mailers or the, or the waiving of the loans. As of now, the amount of money on loan waivers is 2 times that spent on Narega year to date. And since we are in election mode in many states, one can expect state governments, which is the right pocket of the government, if you will, announcing more loan waivers. You add the 2 up, you add Narega and you add up the loan waivers, you come to a number which starts to impact the fiscal deficit. And if fiscal deficits start getting impacted, I can imagine what the Moody's and the S&Ps and the Fitches are likely to say. And they'll say we're putting India on a negative watch. And if they put India on a negative watch, that's again how you scare off bond investors, or particularly bond investors. You may not scare off the equity investors by putting India on negative watch, but you will scare off the bond investors. Their action weakens the rupee. If they begin to sell, weakens the rupee. Please note, in the last year and a half or so, bond investments into India have been more than foreign equity investments in India. So you're more susceptible now to what the bond investors likely to do than what the foreign equity investors likely to do.
Right. Ajit, a growing number of investors are getting increasingly wary of mid-caps given their valuations and the way that they have run up. Having said that, historically, mid-caps have always outperformed the large caps. Just wanted your thoughts on that.
So if you do a graph, and we have that, that's why I know, and I'm smiling because I've done that. You do a graph from January 2005 up till today, you won't find the outperformance of the BSE Midcap Index or the BSE Small Cap Index to the BSE 30 Index. There are periods in time, periods like this, when people kind of lose rationality and everyone rushes in because of emotion. In those periods, yes, mid-caps have done very well, small caps have done very well. You saw it in the BRIC environment, when everyone said India was going to be a superpower, and the BRICS and the small cap, mid-cap indices and mutual funds did very well. Come Lehman, the small cap, mid-cap indices collapsed by 80 to 90%, and they came right down. And again, now you've gone to madness since 2013. So they've had a phenomenal run-up compared to the BSE 30 index or the NSE 50 index. And to that extent, it looks good. But you look at on a longer period, for the risk you've taken for being in a relatively less liquid small cap fund or a relatively less liquid mid-cap fund, you've not received the return and the reward for being in a higher risk category. In fact, I wrote an article on this recently talking about the illiquidity of the mid-cap and small-cap funds. I mean, I put this data out there. We looked at the 10 largest funds. I think in this case we did 5, but we looked at 10. And HDFC, I think HDFC Mid-Cap Opportunity Fund is the largest. Their largest holding, if there was a massive redemption, assuming that there was, it would take over 220 days for them to liquidate their largest holding. And the assumption on this is, you look at the trading pattern of the stock for the last year, and you assume that the manager will not sell more than 1/3 of that average daily volume, because if he sells more than 1/3, he may have a negative impact on the price. So that's an assumption you make. So making that assumption, the portfolios of all these mid-cap funds, by and large, are very illiquid. And so please recognize, again, don't want to panic, don't want to scare people, don't want to frighten people, but please look at the charts. Look at what happened after Lehman to small cap, mid-cap funds. And God forbid, if there is a situation like this, liquidity plays an important criteria in getting your money back. And if a manager sells too much stock too quickly, he hits his own share price and therefore hits the own NAV. And we've seen that cycle before. In a very similar way, the other big thing that's going on today has been the balanced funds. Now, most fund houses, barring Quantum, which I'm associated with, most fund houses have a balanced fund where at least 65% of that money is in equity. That's very unbalanced. Look at what happened to the balanced funds between January, February, and March of 2016. The indices were down about 8%. The balanced funds were down more than the indices. A balanced fund is not supposed to fall more than an index. It's supposed to fall less than an index. But if the balanced fund has equity-like characteristics, it may fall more than the index. So when an investor is being told that take money out of an FD and put money in a balanced fund, he's being misled, he's being missold, he's being misinformed. And he or she need to be very careful. They need to understand the characteristic of the instrument that they are buying. And to that extent, the Quantum Multi-Asset Fund, this is not a promotion, but just a fact. The Quantum Multi-Asset Fund between January and March of 2016 had a decline of 2.5 or 2.8%. It fell less than the index. It fell because we have exposure to equity, but it's not that much that it behaves like an equity fund. So your balanced funds are not balanced. They're extremely unbalanced. And I think investors need to be more and more careful about what exactly they're buying and the risk associated with what they're buying. The returns we all know from the papers and the index and from the TV shows, but the risks need to be really understood before investors plunge in to markets and to instruments.
All right, Ajit, then let's talk about the themes that you think will outperform over the next 3-4 years. Of course, it was the NBFCs over the last 2 years or so. You had the brokerages slash financial services which were doing really well in the last 1 year. You know, what's next?
So I think, again, that's a question of valuation. Again, it's like I indicated earlier on, there will be flows into the financial sector from household savings. So that's great for brokerages, great for mutual funds, great for everything, which is nice. But again, the valuations frighten us. I mean, some of these financial companies are trading at 5 to 6 to 7 times price to forecasted book value. That's a fairly stiff valuation to play by any global metric. And you can talk about the great India story and everything else, but everything is priced for perfection, as if nothing could go wrong. And maybe nothing goes wrong, but maybe something does go wrong, and you do see the correction in valuations. So we're very nervous about that sector. Again, as a value investor, we tend to buy what is not necessarily liked by the market. And technology shares and pharma shares have not been liked by the market for legitimate reasons. In the case of technology, it was the Trump visa issue. In the case of pharma, it is FDA internationally and potential pricing pressures set up by within India to sell their products here. So we like companies which don't have too much debt. We like companies that have cash, and we like companies that have business plans that can kind of over the next few years, decades, show positive cash flow. And the pharma and the IT companies, while they are risky, it's not that there's no risk, they are risky. On a valuation, on a risk-reward basis, they look very attractive to us at this point. So if you look at the Quantum Long-Term Equity Fund, which is managed by Atul Kumar and Nilesh, and if you look at their portfolio over the last year and a half, they've inched up their allocation to these two specific sectors within Quantum Long-Term Equity Fund.
And Ajit, a final question on the primary markets. Do you think that a lot of these retail investors should consider themselves lucky if they missed out on several of these IPOs, especially the insurance ones?
I think they should. I think that, please recognize a company does not hire an investment banker to be a lead manager if that investment banker walks in and says, I think 100 is too high a price for your share. I think only 60 is good for the retail investor. You do a roadshow. You have a beauty. You got a beauty parade, a beauty contest. In the beauty parade, it is the investment banker who offers the company the highest price that wins the mandate. So if Ajit Dayal walks in the room and says, ABC Insurance Company, I think you're worth 60, and I'm going to offer your shares at 60, and someone else walks in the room and says, hey, Ajit's wrong, I think you're worth 60, but I can get you 100 because the market's great. I'm not going to get the mandate. The other guy's going to get the mandate. And therefore, the investor will be paying 100 for something that may be worth 60. So again, we're talking about value and talking about price. Value is intrinsic earning potential of that company and the business. Price is what in this mad moment you feel like paying, or in a depressed moment you don't feel like paying. So it can, prices go all over the place. Value is here. And so therefore I think that in general, IPOs are to be avoided in bullish times because they are priced against the investor. They're priced for the company. Nothing wrong with that. Nothing illegal about that, but recognize that investment bankers are not hired by the retail investor. They're hired by the company to put shares to the retail investor. So be careful.
All right, Ajit, thank you very much for joining us here at BloombergQuint. It was a pleasure talking to you. So, demonetization slowed down India's growth engine, which had just started to probably pick up, or probably it was just bad timing. That's the view coming in from Ajit Dayal, which brings us to the end of this edition of Thank God It's Friday. But have a good weekend, and thank you for watching.